I'm pretty sure all of you are well informed about the Russian invasion into Ukraine and the various socio-economic losses it has caused on a global as well as on a personal level. Some are worried about where their next meal is going to come from, while the others are eagerly waiting for their portfolios to turn green again. Before we dive into the topic, what should investors do during the Russia-Ukraine war? Let us first learn some fundamentals. Hi guys, welcome back. It's been a long overdue. I'm Syed and you're watching YouTube Economics. I'm sure most of you would have heard the term bear market at least once during this wartime. Now, what is a bear market and why is it even called a bear market? Let's find out. Knowing the distinction between these two markets will help you make better investment decisions. Now, typically, when the markets fall or rise by about 20% or more over a gradual period of time, it is essentially called a bear market or bull market, respectively. Typically, about one third of the bear market's decline takes place in about two-thirds of the time, and you guessed it right, the remaining two-thirds in the final third. Thanks to the slow rolling start, you have plenty of time to exit the market only if you're confident a bear market is on its way. Now, before I share a fun fact with you guys, if you know why these markets are called a bear or a bull market, make sure to comment down below. Now, for the guys who don't know, these markets are named after the manner in which these animals attack. That is, a bear usually swipes its paws in a downward direction, while a bull uses its horns in an upward direction to attack its prey. Hence the name bear and bull, respectively. Now I think you've got a pretty good idea about what a bear market is. Now let me remind you, not every fall in the market is a bear market. A correction is different from a bear market. A correction usually occurs because of interest rate changes, bad news, you name it. This is usually about less than 10%. It's steep, sudden, and lasts for about a few days. In fact, it is also healthy for the market to correct after a long bull run. And one more thing, during a correction, the company fundamentals don't change in any way. While on the other hand, during a bear market, a company's or a group of companies' fundamentals might change, or the change is what caused the bear market in the first place. It can be either way. Let me give you another fun fact. Since World War II, we have experienced about 24 bear markets, and on average, it has been observed that there's 24 days of downfall followed by 28 days of recovery. Sometimes a bear market might even be a precursor to a recession. Now, what is a recession? A recession is defined by two consecutive quarters of negative gross domestic product, which is a broad measure of the economy, characterized by decreased consumer spending, increased unemployment, and of course, declining stock prices. Unfortunately, volatility is the price you pay to stay in the market. Now, we have discussed various types of declines in the stock market. But how can you as an investor know if it's actually a bear market or not? For this, you can use a drop below the yearly or multi-year lows as a confirmation to prepare yourself financially as well as mentally. Another way to help confirm if it's a bear market or not is to apply the 200-day moving average on any index such as the Nifty 50. A drop below this 200-day moving average is also a confirmation that a bear market is coming. Okay, finally, we have seen what is a bear market, why it's called a bear market, and how to confirm if it's a bear market. Now let us finally see what should investors do during a bear market. Keep in mind, what you ideally have to do during a bear market depends on your time horizon. If it's usually about less than 3 to 5 years, I would consider selling off at least a portion of the investments. Again, only if you're sure that it's going to be a bear market. Usually, if you're not very much experienced in this field, it's better you just leave the investments alone. Now, talking about leaving your investments alone, let us move on to the next point. First things first, during a bear market, do not panic. Do not panic. Don't listen to the news blindly. Learn what it is from a more economic point of view. Do your own research. And if you don't have the willpower to look at your portfolio in red, there's only one solution. Don't look at it. It's as simple as that. Now, let's take a look at something more practical. As you can see the Nifty chart over the past year, you can see that it has gained slightly over 19% over the year. I think now you can understand why I'm telling you to leave your investments alone if you don't have the willpower to invest. But if you invested during the crash, you would have almost gained at least 10% within 2 weeks or so. But that is up to you.